The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate of growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%.
Bitcoin reached a new all-time high of over $73,000 in March, more than a month before the periodic herring event. Many expected the unprecedented demand from spot Bitcoin exchange-traded funds to push prices to new highs, or at least hold them steady above $70,000, but the going has not been as good as expected. According to Raoul Pal, a renowned macro analyst, crypto enthusiast, and former Goldman Sachs executive, the cryptocurrency market has been negatively impacted by global liquidity conditions, which have been worsened by the Federal Reserve's tightening policy. Pal believes the turbulence could last for a while longer, but he is confident that the Fed will soon ease up on the tightening. Stop using leverage. Expect and ignore drawdowns until this market exceeds our expectations. Pal has repeated this message on several occasions this year. Pal updates us on the bull market and what to expect in his latest video. We present Pal's enlightening video clips. Like this video, subscribe to the channel, and enable post alerts for more.
As I've always said, crypto markets are volatile by nature. It's a 70% volatility asset class. It has deep drawdowns and it has tremendous upside. In fact, it's the best performing asset class in all recorded history. But with that best performance comes volatility. It's something I warn about in this don't fuck this up thesis, which is don't take leverage. Don't try and trade around or FOMO into stuff. Just be careful what you do and stick to the basics, stick to the bigger tokens. If you're going to degen into stuff, do it in the smaller stuff because that stuff's much more volatile. Your probability of getting it wrong is very high, although you can get 100x in the space as well. I understand that's attractive to many people, but I'm trying to keep everybody on the straight and narrow. And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is it's normal. So it's normal in the fact that in the last 12 months, you've probably forgotten this, but this is our fifth or sixth 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top. 6, 5 to 10% drawdowns, 3, 10 to 20% drawdowns, 2, 20 to 30%, 1, 30 to 40, 1, 40 to 70. And that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. Just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, that's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great. And I found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't that I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity, stupid. Remember, I've told everything about this everything code cycle. And those of you in Real Vision Pro Macro and even Pro Crypto, Kevin Kelly and myself talked about it yesterday in Pro Crypto. Liquidity is the big driver of all asset classes and particularly crypto. It's the most receptive to liquidity injections or withdrawals.
This week, the Fed said that starting in June, it will slow the rate at which it lets maturing bond proceeds roll off its balance sheet without reinvesting them. This means that the Fed will be slowing down on QT. Experts say this is a backdoor easing of monetary policy, which means that the Fed knows it needs to cut and start easing as soon as possible but is waiting to fool the market for a little more time. Powell thinks that the line can only go on for a short while longer. Soon, the Fed will have to be honest about its plans, and when it does, the prices of crypto assets will go through the roof. Let's go back to Powell's video.
So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity. And those of you who follow Mike Howell, who's on Real Vision frequently, he also follows liquidity. He's probably the expert on liquidity. And he's talks about the liquidity air pocket that I've looked at as well. The liquidity air pocket was happening. If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT, so they've been tightening it, making liquidity less available. But that's been offset by the Treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The everything code cycle taught you that there is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the everything code cycle I started talking 2 years about. The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate of growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%. Whilst interest payments right now are, let's say, 2-year bonds are 5%. Okay. And if you double that, taking into account the private sector, you've got 10% of interest payments and nominal GDP growing at whatever it is, 5. So there's not enough GDP, which is why the bond market's been freaking out. Over time, yields have risen, even though the Fed have been talking about cutting rates. And this is the issue of not having enough GDP growth. This is the everything code cycle. So what it leads to is what's known as more cowbell, which is stimulus. Stimulus can come in a number of ways. So the most obvious way is reducing interest rates themselves. That has been a typical path. The other way is the backdoor mechanism of injecting liquidity into the system. Quantitative easing is the best known one. The other one is draining the reverse repo and also draining the Treasury General Account. So those tend to be those, and then there's some more coming, and I'll come into that in a sec. So where are we today? Why did we have the air pocket? Well, QT was going on, so they're selling bonds. The Treasury had started building up cash reserves because tax payments have come into the system. They come out of money market funds and go into Janet Yellen's checkbook, checking account, and that's taken liquidity out of the system because she hasn't spent it yet, so it's just sitting there. She's been trying to help the market by issuing short-dated bonds. That's drained the reverse repo. But now today, the market's reversed very quickly on another piece of news. The other piece of news was Jay Powell has said, hey, we don't want to sell as many bonds, quantitative tightening, which is we're going to ease liquidity conditions. Janet, on the other hand, hasn't said that she's going to issue more short-term bonds yet. Well, it's a bit impossible because the reverse repo is almost drained anyway. She's going to wait till closer to the election to unleash her checkbook and throw out money to everybody. And she will do that, and that will come in the second half of the year. So what she's done is another bit of magic. She said, well, what I'm going to do is I'm going to keep issuing these shorter dated bonds, and I'm going to buy back some longer dated bonds. And it's the illiquid off the run ones. But really, it's a recycling of liquidity. It's adding liquidity into the system. So Janet started to add liquidity, and Jay is making sure that he takes less liquidity out of the system. The reverse repo is almost drained. There's a bit more to go, but then it'll come down to Auntie Janet, and she will then start throwing her checks around and handing out money.
Coinbase says that even though we are in the middle of a cryptocurrency bull market, there will still be a lot of instability. This is only enough to cause 20 to 30% drops, but not enough to damage the value permanently. Retweet what Raoul's friend says in his video. If you're hodling, you're ignoring price drops during both bear and bull markets because you know that your patience will pay off in the long run. If you think you can huddle, here's what it means. The first post says there have been 5 Bitcoin bull markets. The last 2 lasted 3.5 years and 1.5 years, respectively. During those times, prices rose 113 times and 19 times, respectively. Prices have also gone up 4 times. To get to the top of an average bull market, you will have to survive the following: 65 to 10% drawdowns, 310 to 20% draw, 220 to 30% downs, 130 to 40% drawdown, and 140 to 70% drawdown, and 140 to 70% drawdown. There have been ups and downs during a bull market. When do you think liquidity will change, and how do you think that will affect Bitcoin and other cryptocurrencies? Please leave your ideas, comments, and observations below, and don't forget to give this video a thumbs up. Sign up for the channel and turn on alerts. Please click the bell to see more movies like this.